the risk is that we've seen such huge tightening this year that actually the deceleration is very sharp. And then if you add in the fact that central banks might be a bit more reluctant than normal to ease monetary policy, then that could make the recession more severe than many are expecting. International headwinds are going to be pretty strong if the US and Europe are going into recession. So China's going to have to generate its own growth rather than relying on other countries. But we think the policy dynamics are in line with them achieving that. So China should accelerate quite significantly in 2023. Once the Fed starts focusing on supporting growth rather than fighting inflation, that's a lot better environment for equities. Obviously, we see today, where we look at it today, that we seem a long way from that point. But we believe we'll reach that inflection point at some point in the second half of next year.
Hello everyone, welcome to SFC Markets and Finance. Chasing back to 2022, inflation and rate hikes are keywords. As 2023 is coming, has inflation peaked? Will major central banks stop hiking rates? How should we manage our personal wealth? Let's welcome Steve Brice, the Chief Investment Officer of Standard Chartered, to join our discussion. Hello Steve, glad to see you. I want to begin with monetary policy. It seems that investors are expecting a policy pivot. Do you think when the Fed will stop hiking rates?
So as we head into the beginning of the year, I think the way that we look at the Fed is that they're very focused on what we call lagging economic indicators. So primarily inflation, of course, but also the labor market situation. So as we go into Q1, we think they're going to continue hiking rates. So we're actually expecting the Fed funds rate to peak around 5.25%. So that's slightly above where the market is currently pricing in the peak. So they're going to remain very focused on those lagging indicators. As we head into the second half of the year, then we expect them to really pivot. So we believe there's a very high probability of a recession in the US in 2023. And once that becomes clear to the Fed, then we believe they'll start cutting rates at some point in the second half of the year.
Since the ECB and the BOE began to hike rates later than the Fed, will they also change their policy direction soon?
So I think it's going to be a similar profile. As you say, they started a bit later, so they'll probably be a little bit more reluctant to pause and ease policy than the Fed will, because they've still got further, especially in Europe's case, they haven't done that much so far. So yes, we think they will ultimately reverse course in the second half of the year, but probably later than the Fed. And probably less aggressively than the Fed as well, given the inflationary pressures we're seeing in the European economies. So similar profile, but less extreme on the cutting cycle.
How about the emerging market?
So I guess, outside of China, emerging markets actually have been pretty aggressive in terms of tightening monetary policy. So obviously different countries have different parts of the cycle. But I think the concern in many countries was the potential weakness of their currencies and obviously raising inflationary pressures as well. So from that perspective, I think emerging markets have probably done largely what they have to do. And we're actually seeing a lot more interest now in people looking at emerging markets generally, trying to lock in the yields that are available in some of these markets. Now, I think definitively the key point here is for central banks to sort of become more relaxed about the situation. Then they'd like to see the dollar definitively peaking. So obviously we've seen some dollar weakness in recent times. But if that was to become a longer term trend, I think then central banks would say they've done enough. And then naturally they can then start focusing on when they might ease policy at some point. But for now, the dollar is going to be key.
You pointed out we are in different economic cycles. So from your perspective, will global monetary policies continue to diverge in 2023?
So I guess we would see, the focus shifting in 2023 from tightening policy to easing policy. So that would make, I guess, the global monetary policy cycle more aligned with each other. China has obviously been the one standout in terms of easing policy at the time the rest of the world has generally been tightening. And I suppose Japan is also a different cycle, but that's more structural in nature. But as I say, if developed markets and emerging markets start thinking at this, late in 2023 about easing policy, then that would sort of bring back people towards the China and Japan view of the world at the moment.
What's the outlook of global inflation next year?
So we do see inflation coming down as we go through 2023. From our perspective, it's going to be a gradual process. So we don't think that inflation will get close to central banks' targets. At least, obviously, we're talking about developed markets in the US and Europe. So we think that by the end of next year, inflation in the US may be around 3%, but obviously that's still significantly above the Fed's official target. And that's really what the challenge is for central banks, is even if you're saying, even if we get a recession and inflation still remains above its target, how quickly can the central banks confidently cut interest rates and ease and support the economy? And I think that's, most people are saying that the recessions in the US at least will be fairly mild. The risk is that we've seen such huge tightening this year that actually the deceleration is very sharp. And then if you add in the fact that central banks might be a bit more reluctant than normal to ease monetary policy, then that could make the recession more severe than many are expecting.
The Fed has made mistakes on inflation. Will the Fed misjudge the US economy again?
Yeah, I mean, look, I have huge sympathy for central banks in this environment. I think that it's not an environment I've seen in my lifetime. Oh, in my lifetime, yes, but not in my working life. So I'm, never lived through something like this. It was very easy to say that inflation was transitory. It's obviously proven to be a much longer standing than most people thought. They're very, very worried about, what happened in the 70s when monetary policy was eased prematurely, and then inflation went, stabilized and then went higher again, and then they had to tighten dramatically. So I think the risks of a policy mistake is more than 50%, because we're likely to get a recession. How severe a policy mistake is going to be is very challenging. But I'm pleased I do my job rather than working in a central bank today, because I think they have a harder job than I do today.
Which region will drive global growth in 2023?
From our perspective, China is going to be a major source of growth, right? So obviously, this year has been a challenging year from an economic perspective for obvious reasons. But if we're looking at next year, we have seen that policy stimulus coming through. Then we believe that the economy will rebound strongly next year. So the consumer is a major part of that play. Obviously, the international headwinds are going to be pretty strong if the US and Europe are going into recession. So China's going to have to generate its own growth rather than relying on other countries. But we think the policy dynamics are in line with them achieving that. So China should accelerate quite significantly in 2023.
Besides China, which country will have more opportunities?
Then it gets a little bit tougher. I guess it's generally speaking it is the emerging world. So obviously commodities have been generally well supported. So in the emerging world, I think, if we're saying which countries are probably likely to turn the corner the quickest, I'd say, if you're looking at Latin America, I think those economies will do pretty well. As I say, they've been tightening monetary policy, but we expect them to back off that, and that this, regionalization of trade rather than globalization, that's probably going to support places like Latin America pretty well. And the same, I think, in the ASEAN part of the world. Again, we're seeing increased foreign direct investment into those economies, so they should be drivers of growth as well. But China is by far the number one for us.
How about Europe?
So it does. I mean, we've already obviously seen gas prices come down quite markedly from their peaks. Obviously, the size of the shock has been pretty, unprecedented. Certainly in my lifetime, we've never seen energy prices go up to that extent in such a short space of time. They do appear to have peaked. Obviously, once we get past the winter, we can sort of look forward a bit more, and say, maybe the worst is past. The European economy obviously is already, likely in recession. So it's still going to be a very challenging year, I think, for 2023. But undoubtedly, the second half should be better than the first half. So yeah, we should be seeing the situation improve as we go through the year, and that's obviously going to be a good thing to see.
Now I want to move to the personal investment. Looking back to 2022, the global stock market is very volatile. Will this trend continue?
So, from our perspective, we do think that the stock market is going to continue to be challenged in the short term, particularly in developed markets, given that growth profile. So, the way that we look at the world today is saying, okay, there's an 80% chance of a recession in Europe, a 75% chance of a recession in the US in the next 12 months. And against that backdrop, if you look at earnings expectations, corporate earnings are expected to still grow, at least in the US, in mid-single digits, which we think is too high. Historically, when you have a recession, the average decline in earnings is around 10, 11%. So if we get the run-of-the-mill recession, then earnings expectations are still significantly too high, and therefore we could see another leg lower in equity markets. The only thing I would say about that is I wouldn't necessarily extrapolate that through the whole of 2023, because once the Fed starts focusing on supporting growth rather than fighting inflation, that's a lot better environment for equities. Obviously, we've seen today, where we look at it today, that we've seen a long way from that point. But we believe we'll reach that inflection point at some point in the second half of next year. So as equity markets weaken, we would probably be looking to increase exposure rather than reduce exposure further.
How long should the investors wait for another bull market?
So I mean, we're looking at the second half. So it's really difficult to time these things. I think maybe I'd frame it in a slightly different way and say, how much could stocks fall further before we see the bottom? Because I think that's as important. So we believe we could see another 20% lower in global equities. So the US stock market, for instance. And the way I look at that is, if you look at the trend of equities this year, basically it forms a nice channel, so a sort of trend lower. Until recently, we're trading at the top end of that trend. So, but we think we could go back to the bottom end of that, which is around 20% lower from where we are today. So, that's something that we'd expect to hit in the first half of the year before bottoming at some point in the second half of 2023.
Which country's market will have more opportunities?
So if we look first from a regional perspective, so we are overweight Asia ex-Japan. And there's several drivers of this, right? So one is valuations. Valuations aren't a major driving force for short-term outlook, but the valuations are cheaper in Asia ex-Japan. I think the second piece is that we talked about the China reopening story. Obviously, China is a major part of the Asia ex-Japan index. And we do believe that reopening story is going to be very positive for very cheap Chinese equities as well. And the third point is the dollar. So the dollar, when the dollar is strengthening, that's usually a headwind for emerging markets generally, whether it be bond asset classes or equities. But it's also true for Asia as well. So if we're right that the dollar will peak, in the first quarter of 2023, that would suggest that we should see tailwinds back, with money coming back into emerging markets and into Asian equities as well, particularly with those positive catalysts. So China and Asia ex-Japan are the two areas that we're very focused on from an investment perspective, in equities at least.
Speaking of sector, which sector will perform better?
So in the developed world, we're pretty defensive. So we're focused on sectors such as energy and healthcare, consumer staples. So areas that, generally their earnings are a little bit more resilient to recessions. So obviously that's the case in healthcare. Healthcare drawdown in earnings during recessions is actually very, very limited. So that's sort of the positioning we have from a US perspective, for instance. When we're talking about the China market, we're obviously a bit more pro-growth. So we're expecting the rebound in economic activity, continued policies supporting domestic economy and consumption. So in China, we're overweight consumer discretionary and also communication services, which we believe are going to perform well. Obviously, they've had a very challenging time for an extended period. But we believe they're going to rebound strongly in 2023.
In your outlook, you mentioned cash and gold are key portfolios, but the gold performed not well in 2022. Will the gold be strong in 2023?
So Yeah, the gold, we're actually overweight coming into 2022, and obviously did very well to start with it up until February, and then interestingly after the Russia-Ukraine conflict, we saw the gold price started coming lower, and I think really what was happening here was actually real interest rates were going significantly higher. Right, so the Fed obviously tightened monetary policy much more than anybody anticipated. Remember, a year ago, the Fed was predicting we'd have 75 basis points of hikes in 2022. We've had four 75 basis point hikes in 4 meetings. So they've obviously dramatically underestimated the tightening that they would impart on the economy and on asset markets, and that's been a headwind for gold, together with the strong dollar. As we see, the Fed back off from that pace of tightening and ultimately moving to cutting rates, and we see the dollar weakening, that should be a much better backdrop for gold. So we have a neutral allocation, which in most portfolios is 5 to 10% allocation to gold in portfolios. So it's not that we're massively bullish, but we do believe the gold price will end 2023 higher relative to where we are today.
How about the cash? Are we back to the era that cash is king?
So obviously, we've seen interest rates going significantly higher. One of the at least from a US dollar perspective, for instance, and in Europe. So one of the questions that we get a lot from our clients is saying, well, finally, I can get 4 to 5% yield just by going into fixed deposits. So why should I invest in other asset classes? And I guess that our answer to that is saying, well, yes, you can. Let's say you do a 12-month fixed deposit. Then you can lock in the yield for 12 months, but then you have the rollover risk in 12 months' time. So where will interest rates be then? And our view, interest rates will be significantly lower in 12 months' time than maybe markets are pricing in. So that's why we're investing in bonds. So we're neutral cash. So we believe it's an important asset allocation decision to still have cash on the sidelines. That's partially because of the yield on offer, but also because if we think that equity markets are going to weaken in the near term, then it's good to have some money on the sidelines to deploy when equity markets are cheaper. So that's why we have a neutral cash allocation today.
I think we will have more challenges in 2023. So do you think what's the best way to plan and manage our personal wealth?
Yeah, so I think a lot of this is actually, thinking about how we react to markets is actually more important than what markets do themselves. So obviously, we've seen very significant weakness in 2022 across bond and equity markets. The key then is to say, okay, how do I respond to that? So the way I would respond to that is saying, okay, I have cash on the sidelines. Let's buy the assets as they go on sale, right? So as you say, next year is not going to be smooth sailing, even if we think it's going to be better than 2022. For equity markets, it's probably going to be more challenging, but it's really just saying, let's look from an investment perspective on a longer term time horizon, whether that be 5 or 10 years, because most of our investment horizons are longer term, and say, against that backdrop, is today an opportunity, or is it something we should be fearful of? And I think for the vast majority of investors, it should be something that we take as an opportunity to add to investment portfolios and to reap the benefits in the coming years.
Should we invest for living forever?
So we have this today, tomorrow, forever framework, right? So most people focus actually on the tomorrow, which is retirement needs or kids' education and things like that. So that's how most people think about the world. Our view is that as we think about future generations, we should also be planning for what we do after we leave this planet. So if you think about it, for somebody in my age, around 50 years old, if you're looking at retirement, then you're probably looking 20 to 50 years into the future, right? We're hopefully going to live a long, healthy life, and you should plan for that. But then also you should think about, well, when I leave, to what extent I should be planning for my kids, or other charitable endeavors that you want to pursue as an individual and want to leave your legacy to future generations, as I say, whether it be your family or outside of your family. So, and then obviously your investment time horizon goes up dramatically, because if you're thinking about that, then you're thinking 50 years plus, and then obviously you can take on more risk in your portfolio. So So we believe that a certain allocation for most wealthy investors should be in the forever bucket. Most people, the majority would still be in the tomorrow bucket of preparing for retirement.
Would you like to give some advices to our investors?
I think it's the key to being a successful investor is actually as much knowing yourself as having a view on financial markets. So if you know that you're somebody that gets very nervous when equity markets or markets are generally lower, then you should tailor your investments accordingly. Whereas if you say, actually, I don't mind, this year's been quite exciting rather than worrying, then it means that actually you can take more risk. So I really think, we often find that investors take too much risk when equity markets are high and then take too little risk now. When equity markets have already fallen sharply, the key is to try and do the reverse and try to make sure that you're comfortable with the investment allocations you have and hold them through the cycle. So, the key is staying invested in the markets, not timing the markets, but time in the markets.
All right, Steve, thank you for your time. Bye.
Okay. Thank you so much for your time. Thank you. Bye.
For stock markets, 2023 will still be challenging. As Brice suggests, investors should take it as a chance to add investment portfolios. That's all for today's show. Thank you for watching. See you.